It is now that time for our Trader Talk segment, and today we are going to bring in chart trader Brett Manning. Hey, Chart, how are you this morning?
Doing pretty good, Jim. How are you?
I'm doing quite well. We've had a lot of activity, be it earnings and the ECB announcement that we had today. Why don't we get your thoughts on what Mario Draghi had to say, and then how it relates to the market and to your game planning?
Yeah, so I think that it's really today is interesting because it's really the combination of the econ data we saw from the U.S. mixed with the tone of what I would call one of the most dovish holds you could imagine from the ECB today. And one of the themes that you and I have talked about quite a bit in our macro discussions is this idea that you can look at the relationship between where the U.S. economy is and where sort of the rest of the world, or at least the developed world, is, and see whether or not there's a synchronicity there, whether or not they're kind of lined up and following the same course. Because at times it really is a global economy and a global economic cycle, and at other times there's a divergence, and you start to kind of move away. And we saw a lot of this, particularly from 2010 to 2012. And again, really in 2016, though the United States did kind of partake of that a little bit. But lately, we've really waffled around this point of whether or not there's convergence or divergence going on between the U.S. and Europe in particular. At times, it looks like it's been a largely divergence over the last year, unquestionably. And and it seems like one of the big trades over the last few months has been the idea of a kind of percolating convergence trade, largely because the Fed has kind of shifted its tone and come back so dramatically, and now we're apparently in an easing cycle. And really, at the end of the day, the best way to measure what's going on with the cycle is to look at what policymakers are doing. And I think that today is a day where, and I think you're seeing this in the market. I think ultimately what we're seeing in the stock market right now is about this sense of, oh, we're back in a divergence world. And you're not seeing it a whole lot in currency markets, which I think is pretty interesting. But you had kind of seen currency markets discounting this a bit over the last couple of days. But today is really an interesting standout spectacle of the United States economy looking much better than expected. And the tone from Draghi was really, we're just about to throw the kitchen sink to avoid an imminent recession kind of feel. I think it was tempered a little bit by the idea that there would be some countermeasures involved in any rate cutting, and that there really wasn't a unanimous sense on the board. But he was pretty clear about the direction things are going, and the data's just deteriorating. And at the same time, you've got Boris Johnson sworn in, and he's ready to approach negotiations with the idea of, hey, if we can renegotiate the structure of the deal, that's great. If not, no big deal. We'll do a no-deal exit, and we'll just get it over with. And that's really contributing probably to the idea of a divergence situation developing again, which should favor a strong dollar, even though we're not really seeing it that much today.
Yeah, and that kind of brings me to my point because you mentioned the dollar. If I wasn't mistaken, and I very well could be, I was thinking that maybe we might have triggered a squeeze in the euro because if I recall, the positioning was to the bearish side.
Absolutely.
But it didn't get anybody scrambling, really. I mean, the euro's up 16. I'm looking at the futures. Euro's up 16 ticks here, and we did see an early pop, and I thought there might have been an extension, but we've really dried up over the last, well, basically since Draghi stopped talking. We had that initial pop, and we've settled back in. There wasn't any type of scrambling as Europe came to a close, and so now I'm wondering what is your take on it? Because I thought there might have been a nice little easy trade in the euro on this pullback to get a pop, maybe a potential squeeze higher, and then maybe we come back in and short it down the road. But we didn't see that today. So is there further weakness in the euro? And then does that lead to strength in the dollar?
Well, so that's what I think. I think, generally speaking, I think the answer to that question is probably yes. I think that there has been a move to temper short interest in the euro. I mean, if you look at just CFTC data in a strict fashion back in May when we first started talking about the idea that we could see a squeeze in the euro. We were sitting with, I think, a little over 100,000 net short contracts from large speculators. And we are basically at the same place now in terms of the exchange rate. And that same number, I think, is down to about 31,000 contracts net short euro. So if you just look strictly through the lens of the futures market and the CME futures market, and as we've talked about, you can look at this, I think, from the same way that you look at things like polling for electoral politics. You don't have to call everybody in the country to understand which candidate is leading. So this is a cross-section of people participating in currency markets, which are the biggest markets of any market. They're the biggest markets in the world in strictly speaking, are currency markets. And this is a small subsection of it. The futures, particularly the Chicago-based futures for something like the euro specifically. But I think it does the same thing that a poll does. And to see that we've seen we only have 30% as much short interest now as we did back in May, even though the exchange rate's in the same place. I think that opens it up for an extension to the downside under a scenario where divergence continues to be the theme. And I think that it's not unreasonable to think divergence could continue to be the theme. And one of the things I talked about in my notes this morning is I think if you're looking for the big difference that's happened in the U.S. in macro data over the last 60 days, in June it was awful. It was terrible data. I mean, we saw some really striking surveys. It just suggested that people were just pulling back in the type of spiral of pulling back that you normally see spark that kind of really gear shift into the contraction kind of side of the cycle where you start to see recessionary numbers. We saw that in June, and then it stopped. And now we see something very different in July. And I think that the factor that really explains that to me is the White House's language around Mexico. It was May 31st when they said we're doing Mexico tariffs. And it was toward the end of June when they said, no, we're not, as long as Mexico does something that will vaguely describe, but we won't release publicly the precise terms by which we'll make that decision, which I think makes it more or less a discretionary decision now from the White House. And I don't think the White House wants to do tariffs with Mexico. I think it would see the downside to that, and so it can claim a victory there that they've actually gotten Mexico to take steps to deal with the migration process, or the migration problem from Central America and up into the United States. They can just claim victory on that, not do the tariffs. And I think that that's what the business world is saying too, that this was more or less an empty threat of doing tariffs with Mexico. We don't need to, over the next 6 months, restructure our supply chains for most North American manufacturing, which I think was the scare in June. And I think that's where that data comes from. And so if that was the source of convergence, the other corollary to that is then that means that maybe we'll start to see language from the Fed. And Gavin and I talked about this on Monday, that the big question that's still out there for the Fed on July 31st is, are they framing this cut, which is definitely coming, and it's definitely going to be 25 basis points. They've already said so in the Wall Street Journal. Are they going to be framing that as a one-off insurance cut? Let's look at that as one end of the spectrum is a one-off insurance cut, and the other end of the spectrum is it's the beginning of an easing cycle. It's the beginning of a concerted attack on too low inflation data to try to get inflation data above 2%, let it stick there so that we're not heading for the next 5 years of feeling like Japan. And I think that that we don't know yet which Fed message we're going to get. And it's not really going to be delivered necessarily on July 31st. To some extent, there will be hints, and then there's going to be Fed speak after that because that opens them up back out of their blackout period, so they can really start to talk to us again. And I think because this has almost the features of an intermeeting cut, because they don't have all of the extra elements involved, they're really going to need to do a lot of communication over the following days to frame what happened. So I think early August is going to be a really important time for the market. And I think what we're seeing today is the sense that the market is starting to say, hey, that really might be communication about something that starts to reduce expectations of further cuts. Because if this divergence situation is back, now they would prefer convergence, but it's tough to see the United States economy is in any kind of similar situation to what we see from the ECB. So I think that what we're seeing right now in the combination of the durable goods data we had this morning, along with the tone that Draghi struck, is the idea that we may be back in a divergence environment, and the market may be heading for some more difficult messaging from the Fed in a week or two. So yeah, but I think that the difference in positioning in the euro, it opens up the possibility that we're finally going to see more of a continuation on the downside if we eat the tail along today's lows, because the positioning has changed. We've got, as I said, 1/3 the level of short interest sitting in the euro as we had back at these same levels back in May.
All right. As far as what I think the Fed speak is going to be, I almost, just based on some of the trends that we've seen, whichever side that the market's tipped in, the Fed's going to go the other way. So if we have a sell-off into that, then the Fed's going to tip it the other direction, and they've been
Ever
doing
the
this balancing
conspiracy
act.
theorist.
But
I love it.
there's no doubt that when that happens, that's been the type of commentary that we've seen. And I think also, when you look at what Mario Draghi did today, he is very careful in how he words things, so that it's very,
Oh yeah, he's
it,
one of the best.
they kind of had an opportunity to say, okay, this is that kitchen sink, we're going to throw it all at that. But I think they still need some room, because if it's going to get worse and worse, as he stated, then they're going to have to come up with new type of schemes to do whatever it takes to save whatever it is that they're trying to accomplish, right? So wherever the balance is going to be, the couple of days leading into the market, that's what the commentary is going to be. And so I guess we just have to wait and see, and maybe position accordingly and do whatever the opposite is. If it's buy the news, or sell the post hype Fed release, whatever it is, that's, I think, the direction that the Fed will end up going. And then even when the Fed announcement is out there, the Fed speakers come out. Oh, look at you! You're short in oil as I'm talking.
Yeah,
Multitasker.
Yeah. Well, I kind of was looking at it, and everything just kind of occurred to me. I need to be doing that right now.
All right. Well, let's talk about that trade then. No one wants to hear my Fed speak anyway.
No, I mean, I am curious about it. I'm still not entirely clear. I understand the concept of that there being a seeming fundamental bias that we're going to get whatever it is the opposite of a critical mass of expectations are. Is that
it's
part of the summary?
I suppose it's more related to where the market is driving. So I guess that's the sentiment that we're
are you talking
leading
about
into a certain direction.
Are you talking about a conscious effort to not affirm extreme market-driven ideas?
For the most part, yes, but
Okay.
I also think that the new unspoken Fed mandate is price stability in the equity markets.
Oh, okay. So too much upside, we need to
Yep.
hike. Too much downside, we need to cut. We're managing equity market pricing.
Yes.
Okay.
No, they're
And
never going to come out and say that.
I know plenty of people who buy into that same exact idea. Absolutely. That is, and there's not any obvious and easy way to refute that idea, because I think it is part of the equation. I think that, they certainly don't want a bubble, right? And they certainly don't want, because everything starts to sync up when equity markets are particularly volatile on the downside. We get correlation going through the roof. It hits other asset markets. Everything tightens up. Counterparties back off. It wreaks havoc. And it actually unquestionably does impact. There's a feedback to the larger economy. It's not something you can say happens in isolation. And at the same time, bubbles are incredibly dangerous. So there's a rationale to that more than just a kind of habit. But I wonder if we are in a strange period now where there is such a fear of slipping into a Japanization coma of inflation on a super large time frame. They might be abstracting themselves outside of this cycle and looking at, where we've been the last 20 years, where we're headed the next 20 years, and the decisions we make now could really be a decision point as to whether or not we're heading into being Japan. And maybe that's actually inescapable, but I feel like Fed theory and Fed staffers and Fed research believe that that process is tied to a failure in Japan to initially, when that type of process was starting, to initially force inflation expectations higher and maintain them no matter what the cost. Because it was the loss of inflation expectations and the entrenchment of expectations of deflation that has caused this, even though I look at the situation as more maybe demographic in nature. And I think there's data that supports that, but I think that the Fed acts according to the theory that it has to do with a failure of Japan to manage inflation expectations properly. And if we're getting into a situation where we've got this strong an economy, this strong everything for the last several years, and we still have such a problem of getting inflation to 2%, that I feel like they see that as the problem. And if they can just force people to start thinking in terms of 2.5 to 3% inflation for a period of time, then they avoid that situation, and they might be willing to risk an equity market bubble to try and make that happen. So I think that there's a possibility there. I'm not unified in my mind about what we're going to see, but I also think that when you see durable goods data like this, it's tough to understand how you're going to head into a monetary policy panic. So I can kind of see both sides of it. And with the equity market strong, that would kind of play into what you're saying.
Well, I think, now this is a very simplistic way to approach this, but I think if there was some way to mandate, either be it the Fed or some type of fiscal ruling, that the companies could no longer use gimmicks, say, like stock buybacks, and they had, and the agenda was, okay, we've got to work on raising wages. Now that would naturally trickle into inflation, and then they would kind of get what they wanted to. But that's never been part of the policy. That's never been,
No.
But I think that would be an easy fix. I've never ever heard anyone even talk about that.
Yeah, right. I think there's going to be a lot of my fundamental thesis in being long gold is that we're headed for a period uniquely tuned toward what I call policy creativity. And generally speaking, just the concept that we're rewriting the rule book on economic policy and, just the idea of a managed political economy. Because there's been so many, because we've lost the Phillips curve, apparently. We've lost the basic levers and buttons that have been dominant in monetary policy and underlying theory for the last 30, 40, 50 years. So because there's this sense that we've lost those typical relationships, for instance, between unemployment and inflation, et cetera, there's a lot of creative thought going on behind the scenes, but that's at one part that could be good, but another part that could be risky. Who knows? And usually it's those sorts of situations that force a higher allocation level to something like a gold, just because it's sort of, it's a store of value or whatever. It's a island to sit on while the ocean is crazy. But yeah, I agree with you that and I don't think I've ever heard that idea put forth either. So we probably will.
Well, you heard it here first then, if that happens.
That's it.
All right.
The Jim Zarosli rule.
All right. So
the Zarosli curve.
there you go. Zarosli, by the way.
Zarosli.
Yeah.
See, I didn't know that.
Yeah.
Zarosli.
All right, my man. So before this one gets too far away, let's talk about this crude oil trade. It's trading basically right where you put it on. 56.30, half-size position, risking 80 ticks. That's a pretty wide risk. So I would advise, if anybody feels that that's a pretty big, well, it is a half-size position, but they could also trade that in the mini crude. I don't know, we don't talk about that very often, but that's a pretty decent product to get involved in. It's half the size of the big crude oil contract.
What's the ticker?
I forget.
QL, is that it?
Yeah, Q. I think it does start with a Q. Yeah, so people can do that. It trades.
No, that's
trades
not it.
okay.
That's
No?
coal.
Oh, all right. Well, we'll figure it out. But there is a mini crude. You could probably look it up on your system out there. But that's a way that you can participate in this using kind of a half size. So if you want to use two lots, two lots is the equivalent of one big. So
Okay. Well, let's talk about why I'm doing it.
Why you're doing
that's
it,
what I
right?
risked.
Mhm.
All right. So risk is just today's highs. A little bit above it. A little play around today's highs. So it's basically like a full size position with a 40 tick risk. which is typically the type of thing that I do. And I needed to be further out with a stop, which means I need to reduce size in the position. So there's no big mystery there. And so the general idea is, number one, what we just talked about with the euro, what we just talked about with positioning the euro relative to a gathering momentum in the divergence trade again. It favors dollar strength. Both of those situations do. And what we've seen, so last time we talked last week, I said, I want to get short crude. Do you remember that? And I said I wanted to see some kind of sideways range develop over the next few days. Do you remember that?
I sure do.
All right. Well, what we've seen over the last few days is a sideways range develop, and so now I'm getting short crude. And the pattern is, if you look at it on an hourly chart, you can kind of see a sideways range with a pop up in the sort of third spot of highs. You got a little bounce initially off of last week's lows, come back down, a little bit higher bounce, and then you come back down, and then a little bit higher bounce, and then you come back down a little sharper, and now maybe you're making a lower high at today's highs. I don't know if you can see that on like a 60-minute chart or a 30-minute chart or whatever. You see kind of what I would call 3 humps and a bump in that range. So you get a sort of 1 high, a 2 high, a 3 high, and then sort of a lower high. And maybe the 3 high can be seen as 2 different little highs, but either way, you've punched through, you've tried to form higher highs and higher lows, and now that has failed, and ultimately you've got a lateral range. And at the same time, we have seen incredible data. Last 3 weeks, incredible data, right? And I kind of like that from the standpoint of shorting, because I'm inoculated against data now in this trade. And I have. I mean, if this works, if we start to see some downside, if we start to see this move back under 55.50, and then eventually break 55, then I really am kind of thinking 50 on this trade. I'm thinking a pretty decent move, and I want to let it play out, but it's got a nice swing trade entry structure to it where I can take a limited risk right now. You have things like continuous contract moving averages that have just rolled over. You're underneath the key levels from the range, but you've still consolidated the downside move. And if we start to see the euro break under today's lows and the dollar break out again, and we see that 70% of short interest in the euro that's been shaken out pour back in that process, especially after what Draghi said today, I don't think that's unreasonable. It all kind of lines up to, and then let's say early next week, we start to see the other side, because data doesn't stay great forever in a row in crude. And we can have some pretty bad data leading to a kind of acceleration of this move, even if then it consolidates. And it gives me a chance on the data, perhaps Tuesday afternoon of next week, to take some profits and at a decent point. And we'll see how it behaves between now and then. I could be totally wrong, of course. We could just hold support levels inside of today's pattern and gradually start to grind back up and shift the basic tape picture that I see right now. But the tape picture that I see right now is bearish despite strong data, and that causes me to want or need to be shorted.
All right, yeah, and I do see the setup that you're talking about, so hopefully those at home can follow along. You can see this dive here. You've got that acceleration up, and then here's the second move, and then I guess today where we saw that uptick to like almost a 57. That would be the high of the most recent one. So now that we're tracking below, actually I have it below today's daily pivot, so that bodes well in your favor. But yes, so hopefully everyone can see what you were talking about your three. What'd you call it?
Three humps and a bump. It's a classic bear. Yeah, it's a classic.
Sounds like a classic rap song.
Yeah, 3 humps and a bump, baby. But yeah, no, it's if you're looking for a downward trend to consolidate laterally, it's nice to see that, because what it really comes down to, the dynamic underneath it is that if you see that second hump, the second high is a breakout above the first one. Mm-hmm. So you're exposing people who are short, people with stops above it, who are playing continuation downside there. You get them all out, but you don't see very much follow through. Right, so it's fundamentally showing that kind of sense that there's not that big cascading bid that's going to come into any kind of strength. Then you move back down, then you bump just above that. You reprove it again with the third hump above the second hump being the same dynamic as the second hump above the first hump, right? So high number 2 above high number 1 proves something. High number 3 over high number 2 reproves the same thing by not extending and following through once you start to hit the stops for anybody who's aggressively shorting momentum downside. And then you roll back over more significantly, and you can't make a higher high the next time through. So it's a weakening dynamic inside of a weakening trend, but consolidated. So you've reorganized the underlying exposure situation a bit by 3 or 4 days of not tanking after doing some tanking. And I think it just it just refills the tank. If you are seeing if this does represent a market that wants to go lower, we went lower 5 days in a row sharply, and now we've kind of taken a break, taken a pause, refreshed the situation, balanced the tape out, and refilled the tank with some fuel for new downside momentum if we start to break those previous lows. So it's a consolidated downward situation. Now, in the bigger picture, it's a sideways pattern and a kind of triangle, and so there's no guarantees here at all. But I just feel like the fact that we could be back in this divergence scenario, we could see a strengthening dollar, and the fact that we've seen such spectacular storage data over really the last 3 weeks combined as a single data point with declining production, big draws. We had the big builds in products last week, and I said that it may take 1 or 2 weeks to build through to crude oil, because you see that refineries kind of pull back a little bit. But we had another huge draw this past week, so it's possible we'll start to see that product build from the previous week show up next week, and maybe starting with API data, which just helps this position a little bit, because then you're kind of working through a burst of almost overly good data, and in that time you've seen the price of crude oil over that 3-week data period decline, which is interesting to see it kind of be not vulnerable. Shorts haven't been losing out when they've been hit with good data.
And that sounds like it would be conducive to a short in something like the XLE, something that Blue Chip Trader has been all over. Weakness in in the energy sector itself.
Sure.
Doesn't it? Don't you think?
I mean, it sounds like if they've been unable to rally with the market, and they've been unable to rally with good crude oil data, and they're turning back down now, then it fits right into the same basic idea.
All right, so there's a thumbs up for Blue Chip's idea. And speaking of equity markets, chart trader, you've been dabbling a little bit. I saw you in Netflix, and I'm not sure if you took the trade in BIDU, but you certainly gave some advice, or whatever you want to call it, in terms of a breakout in BIDU. Are you shifting your strategic approach a little bit?
No, but now, so the BIDU trade, I want to say something else. I look at that daily chart and I see 100 tests written all over it. And yesterday was an intraday pattern. I didn't personally take it. I did see it. I maybe should have personally taken it. I fade my vision back a little bit, and I don't see how we don't end up eventually just like, watching a 99 print happen on BIDU. But I mean, maybe not. It just feels like, I don't know how you don't retest that level, and the way that we saw it a couple, maybe back in 2013 lows look to be right there on a big spike down. Now, I don't know. I wasn't excited about it over a larger time frame than just watching a very specific, relatively easy to track intraday chart pattern play out. And the Netflix one was, I think, just too easy to not take. It was literally a perfect setup for what it was. And I don't think that it's really necessarily something about changing how I'm going to approach things, though I can see it being possible that over the next 6 months or so I might do more trading in individual equities because of where I think we are in the cycle. And I used to, for those who are newer to the service, I used to trade mostly individual equities for years and years. And really, when I switched over to more exclusively top-down trading, probably around 2014 or so, and up until then, I took an awful lot of individual equity trades. So it's certainly something that I've been known to do, and if we start to see a more of a late cycle dynamic where I think that there's some really interesting dynamics that I'm familiar with and that I've taken many times in the past, then I'll probably maybe do a few more individual equity trades. But, it really just depends on the situation.
All right, so we covered currencies, we covered crude, basically we covered the equities. Any trades in the hopper that you have brewing?
I could short NQs again, almost here, kind of looking like it. I think this market wants to make new lows
I
today.
think so too. We've been hovering right around. I mean, I'm looking just to make it easy. Looks like we've got a descending triangle setting up in the S&P,
Yeah.
and it's
I don't
right.
see how that doesn't break that low.
Yeah,
But what's the follow through going to be, and where do I need to put this up? I mean, this is a good little clinic right here. So let's say I take the ES short right now. First thing I'm looking at is where's my first point that I know it has to get to. So the first thing is an order cascade below the previous lows it made. So we're looking at triggering stuff around 3004.
hmm
Exactly how far is that going to go through? Am I saying we're going to see a major extension off this? Because the bias that you feel when you look at that pattern right now is that we have to go explore orders just under that level.
hmm
That's right. There's no way this pattern finds a way to not at least print 3003.5. I feel like it's got to do that. But what do you have to risk if that's all it does to make that setup make sense? You certainly could see a zigzag off of this, which means it could clip back above 3008 as its next move, maybe touch 3009.5 and then roll over. And in that case, if you get short right here at 3006, you're looking at making 2.5 points where you have to risk 4 or 5 points. So right there, that setup doesn't make sense from the standpoint of how I think about these things. I would rather see it do that zigzag first. I want to see this go test 3009, show me a little tail, show me a big offer, and then start to roll back over a tick or two. I get short more around 3007.5 and risk 3 points and look for a first cut at 3003.5. So that's how I would look at that setup right there, to know that I'm getting a situation where I'm risking 3 to make 5 on the initial trim and move stop to break even at a point where I feel like I wouldn't get shaken out if it just comes back and retests the breakdown point, maybe touches 3005 and then rolls over through 3000. But just barreling in here, even though I feel like I know at some point over the next hour it's going to be printing 3003.5, it could lead me into a trap where suddenly I've got a difficult position and then maybe a headline comes out and it's, I'm not having any fun. So I would like to see that shaped up a little bit better first, and then it looks like a trade.
Yeah, I feel the 3,000 level is somewhat vulnerable. I think we're due for a test to see where the inventory is. I don't know how solid it is, though. That's the question, and I think that's the same dilemma that you're somewhat outlining anyway, that you could just see bids pile right back in, and then, your risk is it almost feels like you have to risk a little more, because if there is a breakdown through 3,000, I think we can hit in 29.85, maybe test 29.75 again. I do feel it's
What, in a
vulnerable.
straight line?
Man, in my
I mean,
mind
to
it
talk about the
can.
difference,
In my mind it can,
it
but
can, but I mean, some of the stuff that Gavin and I looked at on Monday suggests that there are a couple red flags there, but we've still got this underlying problem with the short side, which is, we've seen more or less 6 months of money flowing out of stocks and into bonds,
Mhm.
and now we have economic data improving and the Fed set to cut. And it makes for a rebalancing phenomenon, even if people aren't excited about doing it. And I feel like there's always just underneath this bid waiting, because there's money that's got to rebalance. It's been so skewed out of equities and into bonds that there's a possibility of, if you're a fund manager, of just losing all your assets if you are completely on the sidelines during a manic extension to this bull market. And just the fear of that, the fear of missing out, and the fear of just getting destroyed by your benchmark, I think is really a part of the picture right now because of how assets have moved. And it makes for competition to bid on any kind of pullback. And so it's tough for me to see lateral consolidations extending deeply in a one-shot move in a tape that's defined by that kind of dynamic. If the vulnerability was the other way, if we'd had money just piling into stocks for the last 6 months, in terms of just, if you just look at fund flows, and if we had a ton of red flags in terms of robo ratio and AAII survey data and stuff where just people are just like they were in end of January, early February 2018, that kind of situation, then when you get breakdowns of lateral consolidations, you get just a waterfall that happens out of that. But I don't think it's the same context right now. So I'm a little more wary about making sure that I get the kind of setup that allows me to feel good, like the NASDAQ short this morning, where I was able to get that at a point where I knew that even if there was a bid right off of a retest of the lows, that I was in a good risk-reward situation where I got in to be able to make money on even the pattern that didn't work out. And ultimately what happened is the pattern didn't work out, but I had a nicely profitable trade because I was picky about how it's set up. And I think that if you assume that you're going to hit a low and just hit a banana peel through the bottom of it, maybe it will happen, but it just feels tricky right now given the money flows that we've seen. So I guess I'm a little wary on that level. I think you hit 3,003. It'll be interesting to see if we just march right through it. I guess the bearish setup would be, if you're in this trade, the bearish extension would be grindy below that level. You hit 3,003, you see 3,004, you see 3,002.5, you see 3,003, you see 3,001.5, you see 3,002, and it's just a grinding kind of robust move through the level. So we're testing it here, and we'll probably get to kind of see.
And they just bought it right back up on that tick. It's
well, of course
amazing.
they did. I mean, there's algorithms that are designed to do that.
Absolutely.
That's actually makes me bearish right there. What you just saw makes me bearish. That is, somebody owns too much, and they need to find a way to be able to sell it without selling it through the bottom.
Very interesting. And when you see that tape, when you've seen that on the tape, if you've watched the ladder enough, you can see that pattern, and it almost triggers something in your brain, like, oh, I've seen this many times
This
before.
is somebody who doesn't want to sell through the lows, and they're willing to make an investment in it.
Yeah. All right. How the heck did you pick the bottom though? In that, I mean, you did it right at the time when you bought the NASDAQ back, when you took some profit when it was down, it was like 20 points in your favor. That was like the low. How the heck did you do that?
Was it the low?
Oh, yeah. I mean, it popped almost immediately after.
Yeah, but it was a retest, I mean, it was the next point where somebody would try to do that. And it was early enough in the day. Now this has the chance to go right through that low we just made. Watch this thing go.
Yeah. Yep.
That's who just bought it, selling right now, just so you know.
It's so fascinating. It's so fascinating to watch that.
He just got better prices than he would have if he had sold through the lows.
Amazing. But the correct answer was you used the force. That's what I would have said.
Oh, yeah? No, it was definitely the force.
to pick
well,
the lows.
It's going to be interesting to see what happens here. I mean, you get a test of this now, like your theory here, because we are down solidly. We've now gotten through that previous low. We're now sitting there, and we've gotten a eat the tail kind of situation, which is, I mean, obviously the product of what we talked about. But is this now something that starts to grind? If the next bar is just a little bit lower than that low, the next bar is just a little bit lower than that low, nothing flashy, volume can calm down. If we just march a little bit, then it's the most bearish possibility. And then this market could have a decent amount more downside. But it's going to be interesting to see if this eventually just runs into the same thing that we've run into on previous attempts to pull back lately, which is kind of what makes it difficult for me to get aggressively short equities right now, just given the sentiment backdrop, type of stuff Gavin and I talk about on Mondays and Tuesdays. It's just tough to get conviction on that side when you see how imbalanced the exposure has been over such a protracted period. So it'll be interesting to see if we just start to kind of hit a point where it's just tough to push through on the downside. But it's a bearish tape right now. Even I was shorting today, even though I've been bullish every day lately. There's a bearish theme of back-end divergence. Maybe don't get quite as much dovish commentary out of the Fed. Maybe we get the hawkish cut, essentially, coming at the end of July in a situation where we've got cycle risks and the United States back in divergence mode, which is generally, not a tremendous thing for equity markets. So it's going to be interesting to see. It's going to be an interesting indicator, even if you're not in the trade short right now. It's important to watch. It's important to understand what the market's capable of to get a sense of what sort of context we're in.
Yes, I agree. And part of what I was talking about when I was laying out the potential for the market to move lower was it's got to test to see what's at 3,000. It's got to test that. I mean, we're getting
Starting
right
to look
there.
pretty likely, yeah.
Yeah, it just felt like it was somewhat inevitable that 3,000 was going to hit today, and we're about to do it right now, and that they got to see what's there, and it could be one of those cases where they just kind of pull the bids, and we get that little rundown and get that little.
What's the banana peel? Yeah, the
Yeah,
question is,
well,
can we see banana peels in this
well,
market?
yeah, but it could be very quick. I don't think it's a sustained thing. I think it's one of those things where you could just see it slide like, ooh, let's let this little pain trade play out for a short period of time, and then they just scoop it right back up. So, and here we are, trading below 3,000. So this is kind of
So why
a.
did you tell me not to short that?
I didn't tell you not to short it. I was trying
I
to.
clearly remember I said I want to short this, and you said no, you shouldn't short it. So
That's not what I said. I never said that. I got this
I'm
one recorded.
kidding, everybody
I
out there.
I
I said
got
I shouldn't short
I
it.
got this one recorded, Brett. So you know,
Yeah.
I can
Yep.
I guess I can edit it too. So, all right, my man. Well, I think we covered a lot of ground here. If we do get a slight little pullback, are you interested in selling it?
It depends on how it happens. Always to me, I need to see dynamics that make me feel comfortable with that.
All right. Well, fair enough. Well, guess what? I'm going to leave the line open for you. So if you do indeed decide to do that, I want you to walk us through it.
Yeah, and also for anybody with the oil trade, it's moving lower, but I have no plans. I'm not going to play this tight as far as profit taking.
All right,
Let
yeah,
alone.
trading just below 56. We got a potential for a banana peel roll, breaking down
Possible.
through the stops. Yeah. Where is your inside target on this? Do you have one?
Um, maybe test of the previous lows of this trend. Where's that down? Maybe under 55.
All right, under 55. Yeah, I lost my crude oil chart, but I'll grab it back and so everyone can see it again. All right, Brett. Like I said, I'll leave you on for the day, and you can provide any updates while I'm gone. As always, my man, thank you so much for breaking down some trades and some scenarios for us.
All right, Mr. Zarosli. Thank you very much.
You're welcome, my man.
All right, take care.